Day trading equity indices with knockouts and call spreads. We do have a lot of folks who are new to Nadex. We covered binary options earlier. Binary options probably the biggest reason why so many retail customers come to Nadex, but we do have other products. And there are times where you might find knockouts or call spreads to be better suited to your trade depending upon what you're trying to do. So now we are going to go through defining knockouts and call spreads and showing you how you can access the equity markets using these products. Once again, you are going to get this disclaimer that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And the entire day is an educational day. All educational sessions, please do not construe anything we say as a buy or sell recommendation. We are doing this for your education purposes. For this session, I don't need to talk about who is Nadex, and I'm not going to reintroduce myself because we covered that earlier in the day. We are going to jump right into knockouts, what they are, how they work, why we've got the number of knockout contracts that we have, so namely around risk, reward, and capital requirements. It is rather interesting because we've gotten this question several times throughout the day. One, at Nadex, there are no pattern day trading rules. I'm going to repeat that. No pattern day trading rules at Nadex. You can day trade all of our products. You can get in or out as many times as you like. The knockouts, when we talk about knockouts first, one of the cool things about knockouts as well as call spreads is maximizing capital usage so that you can make most efficient use of your trading capital. And that is one of the things we will go through when we talk about knockouts, but that also applies to call spreads. We will go from knockouts to call spreads. The reason I do knockouts first is I think they are our most intuitive product. And when I say that, you'll get, I mean, you might not know what they are right now, but when I explain them to you, you go, that's pretty easy. They're very straightforward. And there is a nuance between knockouts and call spreads, but once you understand knockouts, you will also understand call spreads. And once again, I will do a little bit of a practical demonstration on the Nadex platform and show you knockouts and call spreads. So first up, let's talk about knockouts. What are knockouts? Again, just like binary options, a knockout is a contract. It's important to understand that it's a contract, and it is a contract that trades within a set price range, a predetermined set price range. Now that price range has two levels. There is a lower level and a higher level. The lower level we will call the floor, and the higher level we will call the ceiling. So you've got a contract, it's going to trade in a price range, and that price range, there's a floor and there's a ceiling, and the value of the contract will trade right in line with the underlying contract between the ceiling and floor. This is what we call a Delta 1 product. So for instance, if you are trading a knockout on the Dow Jones Industrial Average, the price that you see is the underlying market. So if the Dow Jones is trading around 35,000, the price for the knockout will be right there around 30. It'll be at 35,000. You are trading the price of the underlying. Now you're not actually trading the underlying. It is a contract, and there's a reason for that. It's a contract, and you are simply exposing yourself to movement in price of the underlying. That is what you were looking for, price action. And it is Delta 1 in as much as it will move directly in line. As the underlying goes up, the knockout goes up. As the underlying goes down, the knockout goes down. That price you are trading is the underlying price of that market. And it will move between the floor and the ceiling. And it really is the same as any other market. When you trade anything else, if you think it's going up, you buy, and if you think it's going down, you sell. If I think the Dow Jones Industrial Average is going higher and it's at 35,000, I simply buy that level, 35,000. I'm trading the price of the underlying index. If it's the S&P, I'm trading the price of the S&P. If it's the Nasdaq, I'm trading the price of the Nasdaq. And the reason it's important that it's a contract and you're not actually trading the underlying is you can buy or sell it. If I think it's going higher, I buy it. If I think it's going lower, I can sell it. And some people have a challenge with how can I sell something that I don't own? And because it's just a contract, you are selling the price of that contract and you're looking to profit if it should go lower. And if you sell it and it goes lower, you can buy it back at a lower price and profit. And if you think it's going higher, you buy it and you would look to sell it at a higher price and profit. All right, that is how you trade a knockout. It is really straightforward. You are trading the price of the underlying, except we've got this floor and ceiling price around it. So let's talk about that floor and ceiling price. A knockout will expire in one of two ways, either by price or by time. Let's talk about price. All right, it's a price triggered settlement. If the underlying index touches either the floor or the ceiling, that contract expires and you are knocked out of your trade. That is why they are called knockouts. If you buy a knockout because you think it's going higher and it goes up to the ceiling and it touches the ceiling, you are knocked out of that contract and you experience maximum potential profit. On the flip side, if I buy a knockout and it goes lower and it touches the floor, that contract is immediately settled and you are knocked out of your trade and you experience maximum potential loss. A knockout, a Delta One product, you are trading the price of the underlying. You buy it if you think it's going up. You sell it if you think it's going down. If you buy it and it goes up and touches the ceiling, you're knocked out. If you buy it and it touches the floor, you're knocked out of the trade. If you think the price is going lower and you sell a knockout, you think it's going lower and it goes down and it touches the floor, you are knocked out of the trade. You experienced maximum potential profit. You sold it, it went down, it touched the floor, you're out of the trade. If you sell it and it goes up, oops, you were wrong, and it touches the ceiling, you would get knocked out for maximum potential loss. Now that begets the question, what happens if you buy or sell a knockout and just like all of the rest of Nadex contracts, there's an expiration date associated with it, and it does not touch the floor or ceiling by expiration, you will then have time triggered settlement. So you buy or sell a knockout and it trades between the floor and ceiling. It never touches either the floor or the ceiling. You're still in your trade. And then when the contract settles at expiration, there will be a price, it will settle, and that's time triggered settlement. And your profit or loss will be the difference between where you bought and sold it and where it settled at expiration. So how does this actually work? And I'm going to show you a few things so you can see it. But when we list knockouts, they start off with 1 week. They're all weekly contracts. We launch them at the beginning of the week. They're weekly contracts. At the beginning of the week, there will be 4 knockouts per contract. So if you're buying or selling the Dow Jones, the Nasdaq, the S&P, each one of those will have 4 knockouts. And if over the course of the week, one of those contracts settles, it touches a floor or ceiling and it settles that contract and it's over, a new contract will be listed so that generally speaking, you should have 4 unique knockouts to choose from at any time during the course of that week. Now let's show you an example. Okay, I'm going to show you an example. Here's an example of the S&P 500. And at the time, the S&P 500 was trading lower. It was down at 2720. And you can see there we are at the beginning of the week. And we listed 4 contracts for the S&P 500. Now, for the S&P 500, they're 50-point wide markets. It's not the same for every equity index, but it doesn't really matter specifically because you'll see this on the charts as well as the order tickets, exactly how wide these spreads are. And just like our binary options, we show you maximum potential profit and loss beforehand. We do all the math for you. But you'll see a knockout. Knockout number 1, it'll be a higher knockout. It'll be down just a little bit, up 40 points, so that you've got a floor and a ceiling spread of 50 points. Then we'll list a knockout that's slightly lower, where the floor is down 20 points and the ceiling's up 30. Again, 50-point spread, and you'll see we list 4 distinct knockouts. Now, what happens? The S&P 500 starts trading. There's our level where we are right now, all right, 2720, and there's the end of the week, all right, that's that red line at the right. It will settle at time. If it doesn't touch the floor or the ceiling of any of these contracts and it just goes sideways all week long, it will eventually settle. But let's just take a look at what happens as the S&P 500 starts moving. Now, it started moving and it started going higher. When it went higher, it eventually touched the ceiling of contract number 4. Boom. Well, it touched the ceiling of contract number 4. Number 4 contract settles. It's knocked out. It's over. Anyone who had bought it, it went up and they got that little bit of profit. They made profit, they're out. Anyone who had sold it just got knocked out for a loss. Contract number 4 is gone. And then because it was going higher, we list a knockout up above so that you'll have 4 knockouts to choose from. Now, same scenario, instead of it going higher, let's take a look at what happens if it went lower. The S&P 500 goes a little bit lower. You can clearly see that it touched the floor of knockout number 1. Knockout number 1 is settled. So if you had bought knockout number 1, you just experienced maximum potential loss. You were knocked out. You thought it was going higher. It went down and it touched the floor. And because we're going lower, we added a new knockout down below so that there are 4 knockouts. Now let's talk about time triggered settlement. And this is why the knockouts are considered a variable payout, because ultimately your potential profit or your potential loss will depend upon where you bought or sold it, and then its final settlement price. And the final settlement price could be a knockout level, the floor or the ceiling, or if it's at the end of the week and it didn't touch any of those, wherever it settles at the end of the week. So here's that same little chart, and you looking ahead at the end of the week, we had 4 knockouts, and you look at the knockout number 4, it traded, it clearly didn't touch the top or the bottom. Oops, I went a little too fast. Your profit or loss would be the difference between where you bought or sold it, and where it settled at the end of the week. So at the end of the week, all the knockouts will have settled. They will have either settled and been knocked out because they touched a floor or ceiling. And at the end of the week, there's 4 of these contracts. They will simply settle at a price, and your profit or loss would be the difference between where you bought. If you bought it and it settled higher, you had a partial profit. If you bought it and it settled lower, you had a partial loss, and vice versa if you sold it. So pretty straightforward. It is, you are trading the price of the underlying, and you've got a floor and a ceiling where you would get knocked out if it touches it, and if it doesn't touch those, there is an expiration at the end of the week. So let's talk about the risk reward. You know what your maximum risk or reward is before you place the trade. You're trading at a price level. It turns into simple math. If you bought it, your maximum loss is it touches the floor. Your maximum profit is it touches the ceiling. So what do that floor and ceiling essentially provide you? And that is natural exit points. Okay, the very structure of a knockout forces a trader to, and we're going to talk, and by the way, the question came in about margin. And because it's not even margin. It's going to be just like any other trade. You're going to have to put up your maximum potential loss. And I'm going to show you the capital efficiencies, because you do essentially get capital efficiencies or effective leverage using knockouts because of the defined risk reward structure. I will get into that as we discuss it. But the very structure of knockouts makes you have a disciplined trading plan. You have a defined profit target and a defined stop loss. If I buy a knockout, I have an exit strategy built into it if I do nothing else. My exit strategy is I want it to go, if I bought it, I want it to touch the ceiling. That's my profit goal. And if I'm wrong and it goes lower, I've got a stop loss. It touches that floor, I am knocked out of the trade. And it's not like a traditional stop loss order where it gets triggered and you send an order to the market. It settles at that price. You cannot lose any more than you initially put into a trade. So you have a baked in stop loss. It's inherent in the structure of the product. And so what you essentially are doing, and we'll talk about this, if you think it's going higher, you might choose a knockout with the highest floor to have the tightest stop loss, because you know if it goes down, you get knocked out if it touches that and you are knocked out of your trade. You've stopped your losses. If you want to have a little bit more wiggle room, you can choose a knockout where the floor is a little bit lower. But essentially, it forces you to have an inherent stop loss on your trade, period. And if you think it's going down and you sell a knockout, if you want to have the tightest stop, you might choose the one with the lowest ceiling, so that if you sell it and it starts going higher, you're knocked out if you're wrong because the price is going higher. Knockouts force a trader to have a trading plan. It forces you to have an inherent stop loss on your trade, because if it goes against you and it touches the floor or ceiling, you're simply knocked out. And it gives you a profit target where you would want it to go your way. And if it does go your way, at some point, if it touches the floor or ceiling and it went your way, you will experience maximum potential profit. Now, when we talk about margins or what your capital requirements are, the risk side, if you're buying, your maximum risk is the difference between where you bought it and the floor. And if you're selling, your maximum risk is the difference between where you sell it and the ceiling. And that is what you need to put up to initiate the trade. It is a fully collateralized trade. You put up your maximum risk. You can never lose more than what you put up. You can never lose more than what you've risked. So there are no surprises. There is never, you can't lose more than what you put up on that trade. You can't blow out your entire account because something went against you. You can't lose more than what you have. You have very defined risk because you put up your maximum risk on the trade and never more than that. And there never is a maintenance margin call or anything like that. They simply don't exist. You've got your initial capital requirements to put on the trade, and that is it. Now, on the reward side, obviously, let's talk. I mean, I've really been emphasizing the risk side, but on the reward side, it's all right. I bought it, and my reward is it goes all the way up to the ceiling. And if it goes higher than the ceiling, I cannot make any more. I will get knocked out at the ceiling. And if I'm selling it, I'm looking for it to go lower, and it hits the floor, I am going to recognize maximum potential profit because I'll get knocked out down below. And if it keeps going lower, I cannot make any more. This trade has very clear, defined risk reward before you enter a trade. So I want to go through an example a little bit more visually so you can see it, because this will help emphasize the point on having how it works on stop losses and how you choose which knockout you would like to use and get the greatest capital efficiency. All right, so I just said a lot. I'm now going to show you. Here's that same example earlier where we had the S&P 500 and I looked at knockout number 1. Now I'm looking to, I think it's going higher, so I chose knockout number 1. I chose the one with the highest floor, so essentially I have the tightest stop. Now, when I buy that contract, I know here's the first moment in time where I'm buying it. There's the end of the week. I know it will settle at the end of the week if it doesn't touch the floor or the ceiling. I know where the floor is. All right, I picked the contract with the highest floor. I know where the ceiling is. That's my ultimate profit goal. All right, and here is where I bought it. Now, visually speaking, I know that is how much I could potentially lose. That is my capital requirement. Whatever my maximum potential losses on the trade is what I have to put up to initiate this trade. That is it, never more, and I could never lose more than that. And the green would be how much potential profit is in the trade. What is my potential profit goal? So we have 4 knockouts for you to choose which risk reward profile suits your trade the most. How much am I willing to risk for what type of reward? How tight do I want to have my stop? You can choose. And if I was willing to have a little bit more wiggle room and give myself, because I don't want, I mean, I think it's going to go higher, but you know, prices don't just go the way you want them to go immediately. It might chop around for a little bit. If it goes down and it touches that floor, I'm knocked out. Now, if I think it's a little too close to the floor, I might choose knockout number 2 to give me a little bit more wiggle room, but my potential profit would be less. And I would see the green to red, or the red to green, my risk reward ratio would be slightly different. I want to show you the same chart, just flip it over. If I thought the S&P were going lower, I might choose knockout number 4. Now, why would I potentially choose knockout number 4? It's got the lowest ceiling. It's got the tightest stop that if I were to sell this and I were wrong and it were to go higher, I want to minimize my risk. So I might choose knockout number 4. And here is that same picture where here's where we are at the beginning on the left. The right is the end of the week. I know my ceiling and my floor. Here's where I'm selling it. All right, I know the level I'm selling it. If it were to go higher and I were wrong, that's my risk. That's what I need to put up on the trade. That's my capital requirement. And what's my potential profit goal? It is the green area. So I can buy or sell knockouts. They are delta 1. I am trading the actual price of the underlying, and I've got very clear, distinct knockout levels, whether at the floor and the ceiling, to either protect my losses or lock in my profits. Now, I've mentioned capital requirements. Since I know the maximum risk before I place my trade, and the capital requirement is my maximum risk, and that never changes, ever. So there are no margin calls ever. And my risk is defined whether I'm buying it or whether I'm selling it. That is why we offer 4 knockouts per contract. And that is so people can choose to make most efficient use of their capital. You can choose, if you don't have a lot of money and you want to minimize your capital requirements, which essentially is what you initially have to put into a trade, you will choose the contract with the least amount of risk so that you can put up the least amount of money. Again, you're taking a directional trade. So if I think it's going higher, I might buy the one with the highest floor so I can put up the least amount of money and hopefully profit by the price going higher. And if I think it's going lower, I might choose the one with the lowest ceiling, again, so that I have to put up the least amount of money. I'm not going to have to ever put up more than what I initially put into a trade. That's it. What you put into a trade is what you put into a trade. You're never going to have to put more, and you can't lose more than that. and hopefully you're right and it goes the direction that you wanted and you profit on the trade. But in the event that you're wrong, you have very clear risk parameters around it. Now let's look at an order ticket for a knockout. It just is not too different than what you see on a binary option. There's going to be indicative price of the underlying, and notice how, and there's going to be timed expiration. It will give you the range of the contract. It'll give you the floor and the ceiling. And if you notice the price that you're actually trading, here, this was on the NASDAQ, the US Tech 100, 15,142, 15,144 and a quarter. A pretty tight bid-ask spread. And notice that the indicative price is right in between there. You're really trading right around the indicative price. Now, if I want to buy or sell this, I can choose to buy or sell. This is an example of buy. Now, I could buy on the offer. I could try to put a bid in between if I wanted to. This is an example of just buying on the offer. Now, if I were to buy one at 15,144 and a quarter, I know, we do the math for you. If it were to go down and touch the floor, 15,107, my maximum loss is 149. And if it were to go up, if I were to buy one here and it went all the way up to 15,257 in the next 4 days in 1 hour, I potentially can make $451. So you choose the knockout range that suits your risk reward profile and your capital requirements, so that you can choose which knockout works best for you. And there's already questions coming in on exiting early, and you're stealing my thunder because I usually save that for the alert at the end. Of course, you can exit these early. In fact, most successful traders will exit early to do exactly what we had spoken about before. Limit your losses even though you've got a tight loss, or to lock in profits. We will get to that. But I love that that's the very first. We got like 3 or 4 of those questions come in right away. It is a Delta One product. You've got these knockout levels and they're calculated for you. And because of that, you can minimize your capital requirements. Now, call spreads. I'm going to go through call spreads because if you understand knockouts, you're going to understand call spreads. Call spreads are very similar to knockouts. Right? It's also a contract. It has a predefined range. That range is also called the floor and the ceiling. Now, the value of a call spread, the price you're trading for a call spread, will move in line with the underlying, similar, but not exactly, to knockouts. Right? Similar, but not exactly. Now, why is that? And that is because call spreads differ from knockouts in 2 very important and distinct ways. So these are the differences between call spreads and knockouts. Number 1, a call spread only expires at expiration. There is no price triggered settlement. That is really important to understand. A call spread is listed and it will trade all the way until expiration and settle at a price. You are not knocked out if it touches the floor or the ceiling. That is important. Now, because of that, there is optionality in a call spread. There is optionality in a call spread, and because of that, volatility and time to expiration will impact the price of a call spread. So a call spread is going to trade at a premium. A call spread is going to trade at a premium because of that optionality. All right. So it is not a Delta One product. You're trading the price of that underlying plus a premium, because if you buy a call spread and and this is the one thing that a lot of people really get frustrated with when they're trading knockouts. They're trading a knockout and they think it's going to go higher, and they buy a knockout and they have that floor in there. That floor it's a stop, and it trades down, it touches the floor, They get knocked out of the trade only to have the contract turn around and take off and go, go higher. And you go, I can't believe it. I bought that knockout. It touched the floor and knocked me out and then went my way. Well, a call spread with that optionality, you could trade a call spread. If it does trade a lower, you're not knocked out. In fact, sometimes people even buy a call spread and it's below the floor a little bit. But there's going to be a premium that you pay. The amount you're going to have to pay is little. It's going to be it's not going to be a lot unless there's a lot of volatility and a lot of time to expiration. That number will adjust accordingly. But you're not knocked out if it goes below the floor, and it gives you time for your trade to potentially be right. And people, if you think a knockout, a product is going lower, you think the Dow Jones is going lower, you can sell a call spread. If it goes up and touches that ceiling because it's going against you, it's going higher, you're not knocked out. You have time for it to come back down and for you to potentially be right. Actually, you know what? Before I jump to the next slide, this is actually really important because people are asking, can you exit early? And I'm going to say yes. And in fact, with call spreads, it's almost a necessity. With call spreads, you really ought to be exiting the trade early. It's your decision. But the reason being, if you bought a call spread, all right, and this is inherent with with a knockout, you buy a knockout, it goes down, you're wrong, you're knocked out. It goes up and you hit maximum profit, you are knocked out. Thank you very much. You walked away from your computer, you didn't notice, it spiked higher and then you got knocked out. You made maximum profit. But what happens if it spikes higher and then comes back down? Now with a knockout, you bought a knockout, it goes up, it touches the ceiling, you got maximum profit, it comes back down, it doesn't matter. You've already got you've got maximum profit. That's it, you're out. A call spread, you buy it and it goes up through the ceiling and you're not paying attention, you're not knocked out. You are still in that trade. You're not going to be able to make a whole lot more money. You can keep going higher and higher and higher. You're probably not going to get much more value out of that contract. So for you to recognize those profits, you would necessarily have to sell it to exit the trade. And if you're not paying attention and that price comes all the way back down, well, you missed your opportunity to profit. So that optionality works in your favor when it goes against you, but it works against you when it goes in your favor. So that thought process, and so I will get to that again in a second, but it is really rather important to understand that a knockout, you're knocked out of the trade and it's clear, distinct boundaries. But with a call spread, and I'm looking at a question, and this is really rather interesting, and we kind of got a little into the deep end because I used the term delta one. When you have a knockout, there is no theta. There is no time decay with a knockout. A knockout, you are trading the price of the underlying. What the price of the underlying is, that is the price of the knockout. That's why I say it's a delta one. You are trading the price of the underlying. With a call spread, there is a premium. There is time decay. There is a volatility component. So with a call spread, there are other factors at play. So that is really the difference. Okay, that is really the difference. Now, all right, and I want to get into examples. I'm going to give myself a little additional time with call spreads and knockouts when we jump over to the platform to answer some of the questions that are coming in. Now, with a call spread, here's our indicative price. At this, there was an hour and a half to go. The Nasdaq was trading at 15,142, almost 143. Here is our call spread, 15,040 to 15,140. So we are at the bottom end of this range. All right, we are at the bottom end of this range. If I wanted to sell this, I'm sorry. We are, I take this back. I'm sorry. We are at the top end of this range. We're at the top. We're up at 15,142. The call spread is 15,040 to 15,140. So we are just above. We are higher than this call. We're actually higher than the ceiling. We are currently higher than the ceiling. Now, I want to sell this. I'm not selling it at 15,142,885. That's where the indicative price is. The market for it is much lower. The market is 15,129 at 15,135. That is that premium component. I've got to sell it lower than where it currently is. All right, that's that premium component. And that's just what it is. Now, I know if I'm selling this, and there's my bid ask spread, if I wanted to sell one at 15,129.50, all right, I know that I cannot lose any more than $42. I would have to put up $42 to trade this call spread, but for it to be profitable, it would have to drop down below 15,140 for me to even be in the range. And because I sold it at 15,129, it would actually have to drop down below there for me to start making a profit. That is that volatility time component that is baked in. And this is a sell example. If I were near the floor, if I were down near 15,040, if that's where it was, and I were looking to buy it, I'd have to pay a little bit more. There is that volatility component, time component. But I also know what my maximum profit is. Defined risk, defined reward, but not exactly delta one, because there's a premium component to it because of the optionality where you are not knocked out of the trade at the floor or the ceiling. Now, again, and I love that these questions came in. Just because there's an expiration associated with knockouts and call spreads does not mean you need to wait until then to see what happens. And in fact, with knockouts, a lot of people will choose the tightest stop. They'll choose the tightest stop. Okay. And so they buy it, they'll choose the one with the highest floor so that they have a tight stop. They know they've got a profit potential, but they might put a limit order in to exit the position early and take a partial profit if it goes their way, depending upon where you're looking for, where you think, where are good entry and exit points. Brian just went through a whole bunch on using Fibonacci. You might find some interesting points to enter a trade and then to potentially exit the trade. You could set your profit goal. If you bought it, you would set a profit goal higher to liquidate. You don't have to wait for it to touch the ceiling. You could get out early to lock in profits. Same goes if you are selling one. You could, you sell a knockout, you chose the lowest ceiling, so you've got a very tight stop on your potential losses, and you could put a bid below to buy it back at a lower price. You don't have to wait for it to go down to the floor to knock you out. You could simply buy it back and recognize a partial profit. Now, you would also potentially do that to limit your losses. I buy a knockout. Do I have to, if it starts going lower, do I have to wait for it to touch the floor and for me to experience maximum potential loss? No. I could, if I bought it and it's going down, and I want to change my mind. You could sell that product back out. You could sell that knockout back out, lock in your losses, but you've limited your losses because you changed your mind. Now, exiting that position with a call spread, much more important because you are never knocked out. You buy a knockout. You buy a call spread. You buy a call spread. Now, again, you buy a call spread and it's near the floor, at or below the floor. Your losses are very, very limited. So you know what you're getting into. But if it starts going your way and going higher, you might want to put in a profit goal where if it goes up to a certain point, you'll simply sell it, take it off the table, take your profits, and move on. Because the call spread will not settle until expiration, and it can go up, it can go down. You do not need to wait until expiration to see what happens. And so trading that call spread before expiration becomes important, not just for limiting your losses, but definitely for locking in profits. All right, that was a lot. Again, email customerservice@nadex.com if you've got questions. I am going to jump over to the platform, and we're going to be able to spend a little bit more time on the platform with knockouts and call spreads because I wanted to get over there so you can see them on the platform, because we do make it pretty easy for you to identify where your knockout levels and where your call spread levels are. And this should answer some of these questions, like how much are these knockout contracts? How much are these call spreads? It all depends. So let's just walk through some examples. And I think you're going to see it. It makes it much easier. It's very visual. So first, I'm going to go under knockouts, and I am going to go to indices. For knockouts, they're weekly contracts. All of them are weekly contracts. So today is Tuesday. These will all have 3 days to go. Here's the US 500. Let's just go ahead and click on any one of these in the S&P. Any one of these, it doesn't matter. And the reason it doesn't matter, I'm now going to hide this. And you can see that there's 3 days and 1 hour left for these knockouts. All right, I am going to do this on our charts. On our charts. First of all, if you wanted to put Fibonacci on here, all right, I could. Extensions, retracements. If I were to put Fibonacci retracement on here, I could, to help me choose some levels. I just did that real quickly. Bottom left, top right. How far out do I want it to go? I'm going to take that off because I don't want to get confusing, but it could help you identify potential levels. Notice on the left-hand side, we've got these 4 vertical blue lines. Those are the knockouts. So you can choose which knockout suits you best. If I thought this were going lower, I might choose the knockout with the lowest ceiling. Okay, and if I were to sell this knockout, I know if I were to sell it right here at 44.3180, and really it's wow, look at that, 44.3190. Delta 1, it's going to trade right in line with the underlying. Let's just say I sold one at 44.3180. I know if it goes up and touches 44.38, the ceiling, 44.38, the ceiling, I would lose $62. I would only have to put up $62 to place this trade. My profit goal would be it comes all the way down to the floor. Okay, and there it would be 43.88 for me to profit $438. Now let's go ahead and just sell one of these for fun, not a buy or sell recommendation. I'm going to place that order, and I placed an order to sell one, and of course I sold one. Okay, and it's showing that I'm currently have a $2 loss because it's assuming I simply buy it back at the offer price of 44.32. Now I have a stop loss baked in. I know I can't lose any more than $62. If this goes higher, that's what I will lose if it touches the ceiling. Now, do I have to wait for it to come all the way down to 44.38 for me to experience maximum potential profit? No, I might think that it's coming back to 44.18. All right, just 44.18 for argument's sake. Could I buy it back at 44.18? I could place an order. I click buy. I put in 44.18. Now I am trying to buy below the market. I could place that order to buy it below the market, and I've now changed a bit of the parameters of my trade because I know that I can't lose any more than the 62 I initially put into the trade, and I'm trying to take a partial profit if it comes back down, and if it gets down to 44.18, I'll take a partial profit on the trade. Okay, and if it comes down there and I buy it, I'm out of my position. And I've got 3 days for this to be happening. And I might, this is just, again, I just picked random prices. I just picked random prices. Now, if I thought the S&P 500 were going higher, I'm sorry, this is the US, yeah, the S&P 500 were going, I might have chosen a different knockout. I might have chosen the one with the highest floor. And if I click buy on this one, I could see now, I mean, we're a bit away from the floor. If I wanted to buy this one, I would have to put up 145. If I were to buy it at, well, actually 32 even. There we go, 32 even. I have to put up 140, and I have a profit goal up above. I do have a loss. Now, people are going to ask, can I have a separate stop loss? We don't currently have a separate stop loss. If I bought this and I was risking 140 and it were going down and I wanted to liquidate, I would have to go and just simply sell the contract and get out of it. Although I have a built-in stop loss if it were to touch the floor. If it were to touch the floor. All right, that is knockouts. I do want to take a look. I've got a few minutes here. Let's just show you the subtle difference with call spreads. I'm going to jump over here to call spreads. I'm going to click on indices. And again, now you'll notice we've got different expirations. Hourly call spreads, daily call spreads. It all depends on the product. You know, in some of these Forex contracts, we've got weekly call spreads. So it all depends. But for indices, because this is about day trading the stock market, let's take a look at the Nasdaq, and I'm going to look at these call spreads at the end of the day. I'm just going to click on any one of them. I'm now going to hide this. Now, instead of the what we now have for you to see the call spreads, let's just do this, is you'll see the shaded region. All right, that has the floor and the ceiling. And this is how you can find a call spread that might suit you. Some of them are wider, some of them are more narrow. So you're asking, what is it for these call spreads? You're going to have to look on each one to determine what your maximum risk, maximum reward are. All right, now we can see that this is trading down, this is toward the floor of this call spread. If I thought it were going higher, I might buy this call spread. I'm gonna have to put up $103, and I've got a $700 potential profit. So it's an $800 range on this call spread. Here's one with a slightly tighter range. All right, and if I were to try to buy this one, I'd only have to put up $10 to potentially make $390. But notice that we are well below the floor. All right, here's where we are right now. I am well below the floor. So the call spreads allow you to also potentially maximize your capital usage. Whether you're now, if I thought it were going lower, I might want to, you know, I might want to find a different call spread. All right, if I thought it were going lower, I might want to find one. And you know, right now there wasn't a particular one here that necessarily suited. Let's take a look at the daily ones. There might be a better call spread. So really what you have, I mean, it does help that you can click around and see these shaded regions. And if I'm looking to sell, I click the sell, it'll shade it red. I'm looking, if I wanted to see one to the downside, this would be pretty much the closest call spread that I've got, where I'm right in the middle of it. So depending upon what you're looking to do, what your opinion is it going higher, is it going lower, you might want to take a look at the various calls, and I do want to refresh these, the various call spread options, the various knockout options that would potentially suit your trade the best. Here we go. Here's a call spread where if you thought it were going lower, this might be a better call spread, right? It's currently trading at 1549. I would have to sell it down at 1541. So you know, that's that premium that it would cost me. I still have an hour and 9 minutes, but I know my maximum loss is $36. I could not lose any more than $36 on this trade, and I'm looking for it to go lower where I could potentially profit $164. All right, that was a lot on call spreads and knockouts. They are slightly different. Knockouts, Delta 1, hard knockout levels. Call spreads are going to have a time component and volatility component to it, but you are not knocked out if you touch one of the floor or ceiling levels. You've got time for your contract to be right. And with both knockouts and call spreads, you can definitely exit the trade early if you want to lock in profits or minimize losses.